Hey, here we go. Look at this. All right, what do we got? This guy's got questions.
Yes. Okay, Chris, my first question here.
I feel like I'm on a game show.
Is in regards to the infinite banking concept,
Okay.
What is your favorite split design? Okay, and just for the audience understands, naturally when we're referring to a split of a policy, that means how much money is going to base premium, how much money is going to PUA.
Yep.
We've got the popular ones, 60-40, 90-10, 70-30, in that range, right?
Yep.
And there's a lot of arguments in the space going back and forth. No, you're wrong, this is wrong. I'm looking for that level playing field, that solid ground. This is you can't go wrong in terms of funding a policy for a short period of time or a really long period of time or until death do us part, right?
Yeah.
In your opinion and your years in the space, when working with clients, or what's your go-to split design to start with?
You're gonna hate me. I don't have one. It really is based on the conversation that I have with the client, right? So for instance, if they have a lot of money to put into the policy up front, right, it changes everything. Changes everything, right? So there is no doing a 1090 policy if you have a bunch of money to front load a policy with, right? So you can't even do that if you wanted to. Aside from that, it really is a function of the blend of what are they using the policy for, right? Because everybody's different. If they want to use it for real estate investing, all right, what's their time frame and when they want to do the real estate investing? What kind of properties are they going to build? How much liquidity do they need to be able to get that property? And what time frame? It's these questions that matters more than anything else. So here's how I do. I don't, and we kind of talked about this a little bit before, but it's not just about the illustration. It's not just about the internal rate of return of the policy. It's about, we need to stop thinking about the returns of the policy and start thinking about the results of your life, right? Okay. And so this asset is simply an asset that you're trying to utilize and leverage to increase your stability, to increase your guarantees, to be a savings alternative, and to give you more control. Fair enough? Fair. It's leverage, right? Each dollar is performing multiple functions and all that stuff that we talk about constantly. And so that's all there. But now, let's stop talking about the policy. When I have conversations with people, I'll hop on with some of my agents, with some of their people. I'll go through a conversation and never even talk about life insurance.
Okay.
Because the illustration doesn't matter.
Yeah.
The policy doesn't matter until I know who are you, what are your goals, what are your objectives, what's your end game goal, where are you now, where are we starting from, where's the gap, what's holding you back, and if you say, hey, I want to do real estate, or I want to start a business, or I want to, buy cars to rent on Turo, or I want to do, anything of that nature. As soon as I understand what your objective is and what your time frame is and what your cash flow is and what your debt is and all these, now we could start having conversations about how do we design the policy. Now, if we want to isolate and just say, oh, what's the best way to look at a policy if we just never touched it? Well, I'm going to tell you, if you're going to put a policy there and never touch it, you're probably not going to want to buy a policy.
Okay.
Realistically speaking.
I like that.
Right? Let me take a step back on that because I probably sounded too bold. If you wanted to use it as emergency fund, right, which we all do, then fund it to that level and then you'd be done, right? You'd be done. When you hit your 6 months of income or your year of income or whatever the number is that, you think you need an emergency fund. So that's what that would be. But, if you're looking to leverage, I think most people who watch our channel, who watch his channel, who watch your channel, who watch most of the people on this topic on YouTube are doing this because they want to leverage it to create wealth. Fair enough?
Fair.
Okay. So if that's the case, it's not just about the policy. The biggest variable to you reaching your goals is not the policy, it's how you use the policy.
All right.
So we need to design the policy to match your use of the policy.
So let me ask. So what you're saying is, if somebody's goal is strictly retirement planning with a rainy day fund, versus they want to leverage that policy to immediately access cash value for investments, there's a different design.
Totally different design.
Right.
Totally different design. Totally.
Exactly.
All right, so I'm gonna give a little case, a little pushback. All right.
All right, push.
Let's say, let me give you a scenario, and this is just based off the clients that I've worked with around the number range. Let's say someone wants to pay in $20,000 a year, and they're like, you know what, Chris, I want to pay this in for as long as humanly possible, that 20 grand. Is there a more a policy split that makes the most sense for that? Like when you can narrow the conversation and then say, yeah, okay,
but
this is where I would lean towards.
You're still, once again, you're getting away from it, right?
Am I?
Why are they using it? Why? They want to put money in. That's great that they want to pay forever, but why? Why?
I'll give you some why.
Yeah, give me why.
So they want to simply save more effectively, have their savings earn a higher rate of return.
Okay, so what's the goal for savings? I'm going to just talk to you like, okay, you're a client you gave me. I want to save money. For an emergency fund?
Emergency, I lose a job, a backup stream of income. And,
how much money do you think you need for emergency?
Let's do 6 months to 1 year worth.
How much money is that to you?
Let's say that is $100,000.
So you need $100,000.
Yeah.
So what you're telling me is at $20,000, within 5 to 7 years in the policy, you hit your goal. Okay. So from that line of thinking, if that's all you want the policy for, you stop funding the policy because you hit your goal. Right? Okay. So this is why people go, I only want to fund a policy for 7 years, but like if you knew what I knew, you would never want to stop funding it 7 years because you just paid all the expenses and went through the most inefficient period of the contract, right? So why would you, if you went through this period and you went through the most inefficient period of the contract, just when it's starting to get good, why would you stop funding something?
Right. So back to my case study, the person does want to go a long time, so that's not a problem.
Okay, that's fair.
Fund a while.
All right, so now talk to me. So we have, once again, why, right? Like, so what do you want to do with the money?
Because the policy is going to perform great. When I reach old age, the death benefit is going to be huge by then.
All right. Do you have any other assets? A pension, 401k, qualified money, real estate, cash flow, anything?
As I'm saving this 20 grand each and every year, as the cash builds up, I will use the money, borrow against it to invest in real estate.
Okay, so that is part of the why. You are planning on leveraging the policy for that.
As it continues to go.
Okay, so that's awesome, right? So now that comes into the equation, right? Okay. So when it comes to policy design, we have to look at it, and it's different for everybody based on their age, based on their health, based on the amount we're funding. Do they have
young guy like me?
Do they have a front load policy? Do they have a front load for the policy?
So
just 20 grand a year.
Yeah, just 20 grand a year, and they don't want to pay no higher, no lower. They're like, this is the number. I promise you, Chris, this is what I'm paying.
Come hell or high water, they can afford 20 grand a year no matter what.
I'm 30 years old, and I'm going to pay this 20 grand all the way into
they got to trust, and it's
70s,
guaranteed.
All
right.
Period.
I mean, so listen. There's the people on both sides of the spectrum, right? Yeah. There's the Nashites, as I call them.
The Nashites.
The Nashites that
it's just 60-40.
Swear it's 40-60. I call it, by the way, I always say the base first. I always say base first.
I messed that up.
It's okay. It's not like it's a habit. So just so we're not like talking backwards.
Yeah.
But 40-60, and they just kind of do it. And the reason he came up with that, it wasn't like some magical algorithm. It was just like having all base didn't make sense, right?
And having all cash.
And having all cash doesn't make sense. And so once again, we have to look at the people that focus on the 1090 policies, right? So let's talk about both, okay?
Yeah.
I think, like, and don't get me wrong, we do that, right? Like, we do some of those. I would say probably 20% of our policies that we sell wind up being 1090s.
That's awesome.
Maybe 15 to 20%, okay? Yeah. So it's like, it's not that they don't have a place. But the more you get to know me, the more you learn. Like, if anybody's telling you there's an absolute way to do anything with your money, run the other way. It's just not the way it works.
Being fully transparent to my audience, this is me, a 27-year-old entrepreneur, learning and growing from my position because I'm coming from a place where I thought or would think that the lowest minimum base premium, max cash, seems to be the way to go. It's the most cash up front. It's the least amount of commission for the agent. It just sounds like the best argument.
And there's so much truth in that. Yeah. Honestly, there is. But here's the problem. one of my favorite quotes that I've started adopting and using in almost every video I make is don't try to solve long-term problems with short-term thinking.
Okay.
Okay? So you're 26.
Yeah.
27. Oh, you grew up. He's getting older since I met him. So you're 27. You just told me about your girlfriend. That's awesome. Do you plan on having kids ever?
Yes.
Okay. How many?
At least three.
I got 3
That's
too.
the goal.
It's expensive. So you're going to need some life insurance. Is that fair?
Big time.
All right. Do you want to leave them with more or less than you came into this world with?
Way more.
Okay. So when we look at this, when you're thinking, when we think of 1090 policies, if it's an absolute like, hey Chris, I've got this property that I need to that I'm looking to buy. I want to do cash flow hacking and borrow against my policy, and I want to put it into the real estate for either a down payment or whatever amount. Well, maybe we have to do a 1090 to keep that liquidity as much as possible to jam it in, because it's a give and take, right? And so that liquidity is really important. But now I understand why the person needs it, why we're designing it that way. And it's not just because we're trying to get a return or not return or have the policy do a certain thing. It's to achieve a result in his life to accomplish a goal, to get the real estate to help catapult in that way. Does that make sense?
Yes.
If he told me, I think I want to get a real estate property in the next 4 years, and then we'd have a talk about, well, what kind of property are you going to get? What kind of down payment you need? Now, what does your cash flow look like? Once again, we're going to structure the policy to help him accomplish that goal and also balance it out from a long-term perspective, like what's the death benefit look like from a long-term perspective. Because here's the deal. You're 27 years old. You're never going to be healthier, more insurable, cost of insurance, everything than you are right now. By going a 1090 policy with everything you do right now, if that's in fact what you were to do, like if you were just coming into this and I was talking to you as a client, like you are making short-term decisions based on kind of a scarcity mindset of like less commission, less this, less that. And everything's, it's true. That's the way it works. But there's also value in the higher base as far as how the policy performs throughout your life. Right? So is it fair to say that when you get older, you're going to want to have disability or all the living benefits? Right? The living benefits are based on the base, not the term. That's all important. Right? The death benefit, eventually the term, you're going to have more death benefit. You're going to have more death benefit with a higher base from a long-term perspective. Right? Okay. So knowing that eventually you're going to have to deal with these problems, challenges, goals, right? Call them what you will. By shorting yourself and going 1090 right now, unless you are really, really good at creating revenue, which you are better than most, right? Yeah, but for a lot of our clients that are maybe like W-2 income people that aren't going to do that, and maybe they get real estate, whatever. But when we do 1090 policies, what happens a lot of times is we eat up their insurability. By the time they go, ooh, I need another policy, I want another, they don't even qualify. They don't qualify for more insurance.
Really?
We've run into that. I've seen that so many times.
So I would be an example of that. So I currently have about $5 million in death benefit on me. Would you say I'm about probably fully maxed out?
I don't know your income. I don't know,
okay. I would have to increase.
You could probably get 30 to 40 times income, okay. But by the time you start getting more than $5 million, now they're going to do a financial audit. They're going to start really checking into you.
Gotcha.
So because you did 1090, what do you have to do in a 1090? You have to jam it full of term insurance. That term insurance is not going to be with you long term. It's going to fall off. But for the period of time that it's there, your insurability is eaten up.
Okay.
So you eliminate your ability in some cases, especially for some of these high performers that we're talking about. I've got a guy that wanted to do he's like, Chris, I want to do a 1090 policy, and I got $500,000 I want to front load, and I want to do $200,000 a year for a premium and this and that. And I'm like, bro, you're talking, and we ran the policy, it was like $19 million of insurance.
Gotcha.
And it was like, we could do that, but do you want to get another policy? He's like, yeah, I want to get another one in 6 months. And I'm like, well, then we're not doing it that way.
Okay.
Right? So you gotta,
I see.
Every situation's different.
Final push back to my case study on the dude that is paying in $20,000 a year for as long as humanly possible. in regards to the split again, is there a split that you're going to stay away from in that conversation? So it sounds like 1090 would not be viable, and I agree in that regard. If I'm going to do 20K for a really long period of time, 30 years old, healthy, and I'm going to fund this thing till I die, I probably don't want to do a 1090, but I also probably don't want to do a what in terms of...
I wouldn't do an all-base policy either, because you're going to look at too long of a period of time before the money becomes liquid.
Okay.
So, I mean, honestly, like, the best way to go is start at 50-50. And then based on, look at it and figure out when do they need what liquidity by when. And then when you do that, what happens, then you can be like, oh, they wanted... in a $20,000 a year policy, they wanted $50,000 liquid by year 5 or 4, right? By year 4, they wanted $50,000 liquid, and then you run the numbers, and you go, oh, by doing a 50-50, we only have, $42,000 liquid. They need 50, right? And so what do? We got to go, okay, we're going to go 40-60. And if that doesn't get them there, then you go 70-30. And if that gets them just over there, then I go 35-65, right? And you just kind of like finagle it until you get it to where it needs to be, but you're doing it to match their goal.
Okay. And as it relates to the commission conversation, does that help influence how the agent?
It's so obnoxious. Like not you, but like the is there more commission paid on more base?
Right.
Yes, there is.
Yeah. And does it have an effect on the cash value of the life haul? Yes and no?
So long term, the more base you have, the better the dividends you're going to get paid.
On the guarantees,
on the guarantees.
Yeah.
No, the better the dividend payout is going to be overall. Overall. I could run a policy and show you what the dividend payout is. The higher the base, the higher the dividend payout overall is going to be. Okay. Now, when you do paid up additions, that money goes in there, and that cash is highly liquid, right? Because it's fully paid up insurance and it's operating that way. But like from a pure dividend perspective and control of the policy, doing higher base is better. Now, once again, I wouldn't do 100% base because you got to find that blend, because otherwise, you're looking at 8 to 10 years before you're like having really any significant cash value available, and probably year 15 before you break even, and nobody wants that.
Okay, I like that. I feel like I'm getting somewhere. I feel like there's a happy medium place. I don't know if it's in the 30-70, 20-80 space.
I think we've got influencers all over the internet that sell IUL and then whole life. You got the infinite banking people. You got the whole lifers that are not infinite banking people, right?
Yeah.
And there's 1090, and then there's 40-60, and then anybody that said like there's no absolute. I think we need to get out of the commoditization of these products, because that's all we're doing when we do that.
By the way, this is what I'm trying to.
We need to get out of it.
Yeah.
Right.
Yeah.
We got to get out of the commoditization of these products and realize like these are just tools, and the tool is only as good as the carpenter that the tool is in the hands of, right? And so it's like we create this tool, but like I could give you a 40-60 policy or a 1090 policy, and which is better? Well, it depends on you. Like and what is the most important part? What are we looking for? We're looking for control, right? Liquidity, use, and control of our money. And so control has a different value to different people, right? I'm
willing to release some of this control for a higher gain later.
Well,
some are like, I need the control now.
And that's cool.
Okay.
But, and that's why I say 1090s aren't bad.
Right.
Who's doing it?
Okay.
Right? So if it's like a super savvy entrepreneur, real estate investor, something like that, and they're like, listen, I don't want to give up control, I want the max, I want at it, and then you have the conversation with them and you're like, hey, listen, by doing this, this is what your insurance level is going to be, you're kind of pushing the limit, you may not qualify for another one, are you okay with that? And they go, yeah, that's cool. Maybe they say, no, I'm going to want to do another one in a year, right? So those are the variables and the questions you got to ask. But if they say, no, it's cool, I don't want another one, I just want the liquidity, I want to get going on this, then okay, 1090 is great. So I'm not saying 1090s are bad. I'm just saying the wrong questions are typically getting asked before the 1090s are getting put into place.
Okay. Thank you for that.
Sure.
And to my audience as well, like this is a learning for us. A lot of my audience, finance geek community, we got Sebastian over here, the approved guy, and then Chris with Life 180. In our community, my community specifically, I'm talking to my people right now. We're doing velocity banking initially. We're paying off our debt. We're trying to increase cash flow. We're building up our credit. We're doing all the personal financial management stuff.
Yeah.
And then we're coming across infinite banking, and we're trying to make a healthy decision. So as your leader, I'm also trying to expand my mindset in the infinite banking space to say, there's a conversation for a split maybe being much higher than what I would normally talk about. And for me, as an agent, I'm trying to do the best thing for my client. And I guess the fear I have is like, oh man, I'm getting paid so much more when I write this. I hope they do it right. I hope they use it right. And so like me, I need to have deeper discussions with the client that may take an extra 1 or 2 phone calls before we put the policy in place. So they fully comprehend, hey, if you do this, such and such may happen. If you do this, well, you may have a higher, longer, better rate of return. And on the guarantees, we can prove that. Right. Whereas a 1090, maybe not so much. Maybe the fear, this is going to be my follow-up. In terms of a 1090, some of the fear out there is if you do a 90-10, your policy will become a mech when you're in your 70s and 80s. That's a big fear.
Highly unlikely.
Highly unlikely.
Highly unlikely.
I appreciate.
And by the way, if it gets to that point, you could just stop funding the policy, and like
you're
good. You're good. Like just be done with it. Like you're never really. If you get to the place where you mech it at that point in time, you made a mistake. Like,
you did,
and you can
reverse that mistake.
You can reverse that mistake. Yeah,
you have time.
Yeah.
Okay, cool.
Yeah.
That was a quick one. Next
one.
one.
Typically, by the way, on that, the insurance company will not accept your premium without telling you that it's meching. Like they will refund your premium.
Multiple notices.
Yes. Yeah. They're not going to let you just do that without like.
Okay. Next one here. This is an interesting one that I learned. I forgot the lady's name. It was an interview with Caleb and another lady. Okay. And she talked about annuitizing your infinite banking plan. So once you fully funded an IBC policy, you're in your, I don't know, I want to say your later 60s, 70s, you're in retirement. Does it make sense to borrow against the policy or make withdrawals to put that into an annuity and get guaranteed income from that annuity? Is there a strategy?
Yeah. So, wow, I haven't thought about this one before.
Oh, no, okay.
Okay, but let me think about it real quick. Yes, I mean, I would say it wouldn't make sense to borrow against it, but I could see a withdrawal to cost basis.
Okay.
And utilize that as an annuity strategy, because that's gonna, if you withdraw to cost basis and you surrender a portion of the policy, you still keep everything else rolling, right?
Okay.
And the money that you withdraw, there's no fees, there's no expenses, there's nothing for it. It's all done on a tax favorable basis. Boom, it's great. And now that money you can roll into. Let's say you were paying $20,000 a year, and you're 27 years old, and you pay until you're 67. How much money have you paid into this thing?
Times 20, was that 600?
600. Yeah, let's just call it 600,000 for the sake of it. At that point in time, the policy is going to be worth much more than that. Let's say the policy is worth 1.5 million. 800K. So if you contributed 800K to this, it's probably got $2 million in cash value at that point in time, right? So you could withdraw to cost basis
the 800
in the 800.
Okay.
Right? And you can put that into an annuity. Basically, at 67 years old, if you put it into like a deferred income annuity, like a fixed income annuity,
like a fixed
index annuity, and like let it roll up from 67 to 70, you can get 7% out of that guaranteed income for the rest of your life. And that's going to be way better than anything else. And then you still have the 1.2 million extra that's in the policy doing its thing,
which you can still use however you so please.
Yeah.
So,
and you could still have that there as a volatility buffer, as anything. If you wanted to use it for real estate investing or speculate, like any kind of thing to have fun with, you could do that.
And now that that guaranteed annuity income, I guess the other conversation would be kind of running the math on what the tax cost would be on that income.
Yeah,
right?
yeah.
And say, okay, you know what? Even with the taxes coming out and what you net, you're still guaranteeing this net that's going to cover your cost of living in your golden years.
And I think the mindset behind the woman who probably said that is life insurance companies do two things. They do life insurance, they do annuities.
Yeah.
And they hedge their book of business, right? Because the risk with life insurance is you live too long, and the risk with life is you die too soon. The risk with an annuity is you live too long. Right? And so you're never going to be able to pull the income out of a life insurance product the same way that you're going to be able to pull it out of an annuity. So why try to get
two for one when you can get both for the best of each world?
It's like trying to get a duck to be a hawk, right? And a hawk to be a duck. It's just not going to work, right? Like, so take it out of one, put it into the other, and leverage it the way it's designed to be leveraged.
So with that, is it better to buy an annuity in your later years as an older individual, or with someone at 27-year-old like myself, entrepreneur, does it make sense even?
I wouldn't. No, don't even. No, annuities are not great for accumulation. They're great for distribution. That's what they are good for. They are income insurance. It's building your own personal pension, effectively.
Wow.
Think about it like that. Where annuities are really good is if you're 55 and older. There's a lot of annuities right now that have great bonuses. And so there's two columns of an annuity, right? There's an accumulation column, which is like an assumption column based on an index, right? And let's say the index will have a cap of, let's just call it 4.5 to 5% right now. And it could be anywhere between 0 and 5, right? And so let's say you're going to get that illustration that says, all right, if you put $800,000 into this, we're going to give you, let's just say it averages 4.5% over that period of time, and it's going to compound. And at the end of that, you're going to have an account value. Whenever you decide to annuitize it, or if you want to surrender or withdraw or whatever, you can, right? That is the only downside of annuities. There's a surrender period. So if you want to access some money, you got to watch out. Every contract has a different surrender schedule that you have to deal with. Okay, but where they really, really are amazing is like there's a couple annuities right now. If you put in $800,000, there's a 30% bonus up front. So instead of $800,000, they'd give you $240,000 of bonus, and then they give you a guaranteed roll up of 7% for 10 years.
Wow!
So they say, all right, if you're 55, right, and let's say you got $800,000 in a 401k or an IRA, and you're like, I'm nervous about this market. I'm scared. I don't know what to do. I want to take risk off the table. Outsource that risk to the insurance company, because this is what they do better than any companies in the world. Give it to them, and they say, if you had the $800,000 at 55, and you said, I want to retire and start getting income at 65, you take that $800,000, you give it to the insurance company, they give you a $240,000 bonus, and now you got $1,040,000 instead of $800,000.
Wow.
And that $1,040,000 is guaranteed to get a 7% roll up every year for 10 years. Every single year without interruption. Here's the only caveat. The only way you get to take advantage of all that is if you turn it on for income. But here's the cool part. Everybody heard about the 4% rule, right? The cool part about an annuity is if you take income at 65, you're probably going to get, right now, 6% guaranteed for the rest of your life. For whatever that rolls up to. So that 1 point...
Higher than the 4%.
That $1,040,000 here, I'll tell you what it is here. Let's do some math.
Hope you guys are enjoying this.
Let's do some
math.
How you feeling? And have fun.
Great.
Good.
Great. Yeah, this is awesome. I have a question. I'm going to switch gears on the unvetted, but I want to let you finish with all your questions.
So this kind of answers one of my questions on, do you take an income from your infinite banking policy, or like would you promote that to your clients, or is it maybe something to consider here?
It's definitely to consider here, but I would say it needs to be a more mature policy. If somebody started younger, cool. But if somebody started the policy later,
like at 50,
then it probably doesn't make sense. Right?
Okay.
But that $1,040,000 roughly grew to $2,040,000. It basically doubled, right?
Wow.
And so if we do that times 0.06, you're talking about taking that 800. Getting the bonus, letting it roll up for 10 years, and at 65 years old, getting $122,000 of guaranteed income for the rest of your life. Like, that's insane.
Wow.
There's not another tool in the world that'll do that for you. That's why you need to leverage the life insurance companies for what they do best. The insurance for growth, for liquidity, for leverage, for control, for protecting your family while you're going through your accumulation years. As soon as you hit your distribution years, you got to start thinking about utilizing an annuity to guarantee your income forever.
I love it. I love it. Wonderful, wonderful. Thank you so much.
Yeah, man.
And I appreciate your time
Oh,
here.
man.
I know Seb has been quiet, patient, so I want to give him the floor to ask you a couple questions. I'm done. I'm going to take a back seat and take my notes here. It's been an honor and a privilege to record content.
I'm glad we got to
with you.
connect, man.
Exactly.
Awesome.
In person. This is awesome.
So I had some other questions, but
go for it.
Just the thought that came out of my mind is the last statement you made is, when will it be too late for someone to start an annuity?
No, I mean, almost never. We have somebody that came to us the other day who was 77 years old, and they're freaking out. So there's different types of annuities. There's indexed annuities, there's variable annuities, there's SPIAs, DIAs, like SPIA is single premium immediate annuity. So like you get a 77-year-old, so a SPIA will guarantee your income for the rest of your life at a different rate of payout based on what your age is right now. Because what's the risk to the life insurance company? You live in too long. If you're older, when you start taking the income on a lump sum of money, they know the odds for them, actuarially speaking, are you're not going to take that much income. If you start younger, they know they got to pay you more. So if you get somebody who's in their mid-70s, who's really tight on money, is like, I'm worried about running out of money. I've got like 400 grand. I'm trying to maximize it and leverage it as much as possible. I don't care about having access to the capital. I just want to maximize the cash flow so I can pay my bills. A SPIA, like for a 75-year-old, they can do it. It's like super easy, and it's going to be like almost 8% payout every year on their money.
That's amazing.
SPIA.
A SPIA, single premium immediate annuity. Yeah, so there's all sorts of stuff like that.
That's great. That's great. That's awesome.
And yeah, we do all that. Like that kind of coaching for people. Like you gotta.
It has to be a
and
part
I know
of
you deal with a lot of younger people, right? So
no, in
you
fact,
don't?
Really? No. My average clientele is between 40 and 55. And
really?
Up. Yeah. I'm dealing
That's
with
awesome.
moms, dads, single moms, single dads that are like, we love your stuff, and I'm like, why are you
That's
even
awesome,
listening
man.
to me? I'm like nowhere near there.
It's because they know you care. They can tell you're authentic. That's why.
That's it, man.
That's
why.
where it's at. So yeah,
that's awesome.
And so these conversations are very relevant to that crowd.
Dude,
We're like, should I get this annuity? Should I get the policy first, then the annuity?
And I want to say this, I got to give you credit because, like, dude, you are vulnerable, right? Like, I love that about you. Like, watching your content, you're just real. Like, you're not trying, like, you're not a know-it-all. Like, you're like.
Yeah. I'm I made a mistake. I'm sorry.
No, but you didn't make a mistake,
right,
though.
Yeah.
You're just expanding. Yeah. That's all. Like, and everybody does it. Go talk to Caleb. Like, he'll tell you he did it one way for a long time. And now, if you were to ask him his opinion on how to do all this right now compared to 5 years ago, it is literally 180 degrees different. Like, 180. Like, it's a normal part of the process. The great news about it is that with what you've done, you haven't hurt anybody. Like, with Caleb, the way he used to do things, he didn't hurt anybody. Everybody's good. Now, could it have been a little better optimized? Sure. But nobody got hurt, and everybody is still, to this day, better off for working with you and with Caleb. And when I first started,
doing it on
right?
Their own,
Right, exactly.
Or sticking to the traditional
But that's
system.
the beautiful thing about, like, doing things the way that we do and utilizing the types of products and the philosophies that we all kind of encompass. Like, there's always a growth curve and the journey and whatever, and different perspectives. And the good news, you don't have to agree with me or you or other people on YouTube about these, because we all have like our own little thing. You're not really going to get hurt with working with anybody, like, because it's all dealing with the same products that are designed to protect first, right? And have the guarantees first, no matter how you design it, no matter what you do. That's the good news. Find the person that you align with the most. If it's Denzel, if it's, I'm not going to rip off all the influencer names, but if it's anybody, like, find the person that you align with the most and work with them.
Okay, so with that, how do we as content creators in this small infinite banking space, what are some ways that we can unite the space? Because I know you've got content that is like, you're
I'm gonna interject here and take my questions. But let's come back to that question.
Yeah. Go ahead.
That's a good question.
We're gonna go back there.
But it sounds like what you're saying is there's room for growth in the kingdom.
Yes.
And it's okay to repent and improve yourself.
Yeah.
That's what you're saying.
Totally. Meaning change your mind. Yeah. Right. Change the way you think. Awesome. Love it.
So my question is, my audience primarily are startup businesses, entrepreneurs, folks that are ready to either start a business or they're in business, they're looking to expand and grow their business.
Okay.
Right. So we were talking about bank-owned policies earlier.
Sure.
Right?
Yeah.
So if we could talk just a little bit about that, and how can business owners not only use life insurance, whole life insurance policies to leverage for their own investments, right?
Yeah.
But how can they also use that to benefit their business, their employees? Is that something that they can do? Can a business owner take a policy out on one of their execs or one of their employees, and how is that beneficial to the business owner and the employee?
There's all sorts of ways to do this, right? Like, we could probably do a 2-hour video just on this topic. So there's I'm going to start with the thing that's like at the top of my head. There's ways now that you can even run qualified plans with whole life insurance. And like the companies we work with have divisions now where they've committed like teams of people that will run qualified plans. So it depends on the size of the business. Like, so if you're a sole proprietor and you're running an LLC and maybe you're doing a couple $100,000 a year in revenue and you want to pay yourself like a solo 401k, or maybe you get 2 or 3 employees for an assistant and you want to like create some, like I got a buddy who's an eye doctor. He does probably $800,000 a year in revenue, right? Pays a couple people $50,000 a year, has a 401k, matches 3%, does that, right? You can do that, but he's also like super anti-market, right? Like doesn't want the risk. He's like really, really risk averse and doesn't want his employees to be in there. So we talk to him, and it's like we're doing a whole qualified plan utilizing whole life insurance. Inside of the qualified plan, it gets all of his employees will have the policies, will have the liquidity. He gets the write-off. Now, it does affect the tax implications, but you have the guarantees and all the growth and all the things, in the policy for that. So that's one way. I just wanted to get that out. Like, it's not something we do a lot of because it's just not something people think about a lot. I think the more common way that it happens in businesses is typically through key person insurance. On like for me, right? Like, so we're going through this process right now for me with Life 180. We're growing it, right? And it's like, if I die right now, Life 180 is in trouble. Like, they better have a lot of money and like be able to replace me, right? And so, because of what we're building, that now we have a responsibility to all these agents that we're working with, right? And so we got to get millions of dollars of life insurance, but now what do we need for a business? We need an operating fund, right? Like, we spend a lot of money on marketing. I travel a lot. We go to events. We do all these things where, I want to have a couple $100,000 liquid for all this stuff at any point in time, right? And that's like a non-negotiable. Like, that has to happen. And so the question is, where are we going to keep that money? Typically, people are keeping it in a bank account, right? Now, everybody's got a business credit card, right? And so you use a business credit card. I don't need a lot of money in my bank account. I've got a $40,000 credit line. You just put your expenses on that, and then at the end of the month, like, I can have the money go into my whole life policy. I can borrow against it. I can pay the credit card bill, and then I can take cash flow from the business as I generate it and put it back to the policy, recapitalize that loan, and I'm never interrupting the growth of the money. Right? Like, so from that perspective, like, that's just a way. I'm just sharing kind of like what we're doing, but like, that can work in any business, and we spend our money on marketing, like, and we're looking to scale a lot of ads. I mean, like, a lot on ads, right? And like stuff of that nature, some technology, some, systems, and like building calculators and doing stuff like that. So there's some expenses, but, get into another business. Maybe they have need to buy like service vans, like think about like HVAC people, or like small businesses that have the need for equipment or whatever. It's the same concept. You still need liquid capital for operating funds, and to do that. Now, the other way to do it is that you can utilize it as like what we would call a golden handcuff situation. One of the hardest part for good business owners is to retain good people, right? So if I'm starting a business and I find Seb here, and I go, man, Seb would be a really good guy to hire, which he would be, by the way, And so like I go hire Seb, but my biggest fear as a business owner is Seb is so good, he's going to only be with me for a short period of time, and then he's going to bounce, right?
Right.
So what I do is I get a policy and I give it to him as a benefit, but I create a vesting schedule. So he only gets it after a certain period of time, right?
Right.
So I own the policy on you. The company controls it. And after the vesting schedule is over, I hand it to you. So instead of giving him a 401k, right, and doing that, I give him this executive bonus structure with a vesting schedule, and I keep you beholden to me. And if you bounce on me before that, it's mine.
Oh.
Right?
So I'm going to think twice before I leave.
Yeah.
Based on what the value of that policy.
You gotta have a really good
You can
offer.
have a good reason to spend. Yeah.
That's really strong. Now, in that structure, you own the policy. I'm insured.
I'm the business
right?
owner, yep.
Who are the beneficiaries?
The beneficiaries right now are the business.
It's the business.
It's the business.
Can the beneficiary, can that be divvied up with maybe 10% to my wife or my kids or whatever
absolutely.
the case is?
Absolutely. In fact, it is required that a portion gets divvied
required.
up.
Okay.
Yep.
So if something happens to me, what you're saying is a portion can go to my family.
Yep.
But then you, as the business owner, get to keep the rest.
Yes.
Well, that's
because you're a key person in my business. I hired you to be, because there is an effective cost to the business. If you're playing a key role and you're like an executive salesperson, and you die,
right,
there is a real hit to my business and my cash flow.
That's pretty powerful.
It's amazing.
That's powerful stuff right there. That is amazing. Very interesting. Another question. When is it a good time, or is it ever a good time, to yet leverage a bank or lender and a line of credit in the business name using the cash value versus a policy line?
So you meaning collateralizing the policy value to getting a line of credit with a bank?
Right. So I've come across at least 4 or 5 lenders that will issue you a business line of credit.
Totally.
At around 3 to 5%.
Still?
Yep. And
still?
Last I checked.
Okay, might change.
I think check again.
We'll check that. We'll have to verify the interest rate. But last I checked, it was 3.
I'm at a 5.45 right now.
5.45?
On my line of credit,
Okay.
And that was in 2022, Q4. I think today it's probably higher.
Yeah. So this was verified this October, November last year.
Okay.
So I'll do. I have to make a couple calls. Verify that. Definitely.
Smacked.
Although,
bottom line is
velocity banking, you bring that rate down.
That's right. And you could practice velocity banking with the line of credit on your business, just like you can on your personal. So, anyways, when is it a good time or a good idea to use that line of credit? Is it better to use that line of credit versus a policy loan?
Yeah, I mean, it all comes down to the cost of money. There's always a cost of money. The beautiful part about a policy loan or a line of credit, the beautiful part about having your money in a policy first, that's the first decision, right? The money's in the policy, is that no matter whether you use a policy loan or whether you use a line of credit with a bank, that money in that policy is going to continually grow uninterrupted, right? Now, that's the other thing. We all say it's uninterrupted. It's not really uninterrupted, because if I don't pay the interest on the policy loan, or if I don't pay the interest on the line of credit, it's going to interrupt the growth, because the net charge is going to be impacted, right? So we got to.
And I always tell you guys, make sure you pay at least that interest. You pay your premium and your interest, and then you can always catch up with your principal depending on how times are. Go ahead.
That is the biggest mistake people make, right? And that is the only mistake that really you can make, is just not funding the policy at all, basically, for too long, or not managing your interest expense. And if you do those two things, you cannot lose with this. But to get back to your question, or point, I guess question is, it's the cost of money thing. So if, in fact, you could get a line of credit at 3% and a whole life policy loan is 5 3/4, well, the cost of money is what it is. Now, the caveat to that is the 3% is going to have structure to it, right? You got to pay that back with structure. And so if you can manage that,
you have to pay it.
You have to pay it. That is a required monthly payment. It is going to go on your credit. It's going to, so you got to understand that. And so it's not that it's better or worse, it's cheaper, and this is why I was saying earlier, life doesn't exist on a spreadsheet. I can spreadsheet it out and be like, well, mathematically, the line of credit's better because it's 3% versus 5 3/4. But life doesn't exist on that spreadsheet. What's your business look like? What's your cash flow look like? Is your business a very seasonally driven business? Like HVAC companies in Arizona where I live, they make all their money in the summer. You know what I mean? Like, and so it's like, if they have to pay their line of credit every single month without fail, do they have enough reserves to manage those payments? If not, then they got to go with a whole life policy because it's going to give the flexibility and the control, and they can manage it based on how the cash flow ebbs and flows with their business.
Do you mind if I give a real life situation here?
Yeah,
so
go for it.
In my case, I was torn between, I had over $100,000 in policy loans at 5.6%. And then when I came across the cash value collateral line of credit, I could get it down to a rate of 5.45. But knowing velocity banking, with the math that I was doing, I'm paying less than 1% in actual net costs. The issue that can occur is now I'm required to pay that $100,000. Like, I have a required payment.
So you have $5,600 a year of interest expense that you have to cover, effectively.
Yeah. So in the reality here, though, is if I was to get canceled, YouTube shuts down, I lose my voice, or I become disabled. Now that 5.45 starts to probably hurt a little more than it would inside of a life insurance policy, where it's a more controlled environment than a line of credit, right? And then I also don't have to worry about my credit being ruined if I
totally
miss payments or something, whatever the case may be. So just being able to evaluate that. I know for me, I was like, no, I know what I'm doing, and I'm fairly confident. I got that 100,000 down to it's around 20,000 at the moment.
So are we taking into consideration that the business line of credit would be a tax deduction to the business as well?
Yeah, I mean, it would be.
And in my case, it's a personal cash value line of credit, and I'm working on transferring it to a business line of credit.
That's where it becomes even more advantageous, from what I understand, because now you have that business tax deduction. But what you both are saying makes a lot more sense.
But you could even do that.
More responsibility.
You could do that out of your personal policy too, though. You could loan the money from your personal policy personally to the business. It could be right off the business.
From the insurance carrier?
Yeah.
Just a little extra paperwork.
It's extra paperwork. Mm-hmm.
Okay. Didn't know that.
Yep.
That's the information. Very cool.
Yep. Awesome. I know people that do that.
Very cool. And all the insurance carriers that we use here are pretty much cool with that?
I'm board with that. Yep. Awesome. Yeah, so that's easy. Listen, like, the thing I love about this is just it's leverage inside of a system that protects you against yourself about extending to get over leveraged. Because we look at the world, leverage is beautiful until you do too much of it, like anything else, right?
Yep, right.
Leverage is amazing until you have too much of it, and then you end up like SVB, and like, that's what's happening in the banking system right now. It's not like, it's just too much leverage, and then the situation gets out of control. Right. Interest rates go up, and they become a little upside down. And because they're so leveraged, when they have a 4% liquidation issue, 4% liquidity like basically crashes an entire bank. Like, how does that happen? It's because they're over leveraged, and like, this happens to real estate people, this happens to business owners, this happens to everybody. So this system allows you to implement leverage, but doesn't allow you to get so much leverage that you get in trouble when markets hit hard times.
Awesome.
That's why I love it. Great stuff. So, yeah, man. Anything else? What we got?
I'm satisfied.
We're good?
Yeah.
You good?
Oh, that was just
all right.
Wonderful.
Cool.
Great information, great value.
Awesome.
High level stuff.
Yeah, man. I love it.